Let's talk about the market sentiment. Now, right now, as I mentioned, I've been doing good on my spreads. I've been doing good on my calendar call spreads and the bull put credit spreads, of course, over the last few weeks. Out of the money bull call debit spreads, 40 to 50 days out in time. And of course, my married put's been doing well, but a couple of them took hits this week. Planet Fitness and LTH, my most recent married put, due to earnings. LTH actually beat earnings, had one of their best quarters, but they kept their future guidance even to analyst estimates instead of increasing them, so the stock fell about 2 or 3 points. So it's exactly where I bought it about 30 days ago. But the put, of course, is in place, so that's doing me really well. Now it's time to evaluate that. But we want to talk about the market sentiment tool. What is the market sentiment tool? This is something Ernie created several years ago. And he took a look at about 50 to 60 broad-based indicators and looked at which ones tended to sort of have a precursor, sort of to show a little bit ahead of time where the market was changing. When you saw certain levels, or what we're going to call fences, change on these various 13 indicators, out of the 50 he studied, he found that these work best. And when you hit a certain range of bearish fences versus bullish fences, we get the sell warning, or a strong bearish sell warning. And on the reverse, when you see these enter into the buy fences, the bullish fences, and we have 5 or 6 of these on the bullish and maybe, a few neutral and then none of them negative or none of them in the bearish, then we'll see the strong buy warnings. In the past few days, we've seen sell warnings, not the strong sell warning, but we've seen sell warnings. The put call volume ratio is in a bearish mode. SPX gap over the SMA 20, percentage of stocks over their 20-day moving average, RSI of the SPX MACD gap. And he found that SPX was actually a better indicator than NASDAQ, of course, which fluctuates more. But also, what is there? The TRIN, the VIX is actually, kind of still, excuse me, folks, leaning towards that bullish fence. Percent of stocks hitting a new 52-week high or low, it's right in the middle there. SPX number of days up, it's right there, isn't it? It's right on that fence. What are some of the other ones that we've seen that aren't in? SPX number of days over the SMA 20 and number of days over the SMA 100. That's the one that's holding on to bullish there. Percentage of stocks across the universe of options over the SMA 100 and the SP gap. They're both sort of in the middle. But these 5 indicators that are slipping into the bearish mode are giving us that sell warning. And that's usually a time when I want to think about maybe managing some of my bullish positions, maybe adjusting some of my spreads, pulling off some of my bullish spreads, such as the weekly bull put credit spreads, maybe lowering the number down or maybe reversing and looking into bear call credit spreads or bear put debit spreads longer term, those at the money or out of the money. We've been in neutral for a long time. We see we got the bullish buys back in mid to late April is when the bullish buys started to appear. Really early April is when they first started to appear. Very bullish buys on March 13th, March 11th, and March 10th, and sell warning on 220. But down here, you could kind of see a histogram, a chart of what we're looking at. Let's just look at that last few cycles we just talked about here. As I mentioned, well, we didn't go back all the way to February. We saw that sell warning on February 20th. There we go. Okay. And also in January. But on February 20th, right here, that's when we got that sell warning. We were up at about 6,100. When we see the market falling, it tried to pull back. We saw a light buy here on around the beginning of March. And then the dip continued, and that's when the very bullish buys started to occur, as we mentioned, right around March 14th and March 15th. Is that right? Sorry, let me scroll up again, folks. March 14th and March 15th. So that's when those 13th, 12th, and 11th. And we had a little bit of pull up, not a lot, but I mean, we went back from 5,600 back to 5,800 on the broad-based SPX. We had that bullish move, but then what did we see? We didn't see any sell warnings, but we kind of dipped around here for a while. And then, of course, this here, what do we know what that is? Right? This time frame right here, what is that? I think that would have been this was a time frame of, what was it called? Liberation Day, if I'm not mistaken. So the tariff wars and everything like that, we started to have those dips, and we started to see those strong buys again right around that time period. So I think Liberation Day was April 4th, April 5th. Someone correct me if I'm not correct on that. And that's when that big drop happened. I mean, we were kind of hanging about here. We were doing nothing really. I mean, we were moving in a range. We were moving in a good, stable range. And then the big dip here. We got the buy warnings, tried to fight back up, came back down. Got the buy warnings again. Right at this time, around April 21st, 22nd, 23rd. And we've moved back up from about 5150 up to 5700. But again, now we're really starting to see the sell warnings pop up again. We're up at 5663, starting to see the sell warnings. So it's something to consider for next week. All right, if you have bullish positions, you have bullish stock positions, covered calls that have been doing well, maybe add an extra hedge at this time. I have a full complement of bull put credit spreads. A couple of them expired this week, today. I've got about 3 more that are expiring next week. I might trim out some of the ones that have a profit in them. And my calendar call spreads, I might actually add a short-term put on those positions with the sell warnings. As we've heard, and as you've heard me discuss before, I might look next week to start buying calls on the VIX. I know VIX isn't near its low. It's at 2190. But we've seen this as high as 40 and 50 in the past 4 weeks, 5 weeks. Starting to see those sell warnings again. What's going to happen if the market starts to fall, starts to pull back, as we've seen with the market sentiment tool workforce in the past? Might not be a bad idea to take a couple percent, 2 or 3% of my portfolio into VIX calls there, puts on SPX, puts on SPY if you're more comfortable than that with those situations, just to see how that works. Okay, it's not a bad play. It worked out really well during the. We talked about this, I believe, in February. Actually, in December, we started talking about this. Strangles, long strangles, buying strangles on SPX and or SPY. I used SPY personally. And then, of course, buying calls on the VIX when we start to see these sell warnings coming up. Adding maybe extra protection to some of our positions, such as covered calls, cash secured naked puts, which have that downside. Limiting or trimming, taking some of the profits on our bull put credit spreads, the weekly bull puts, or narrowing down our portfolio exposure, I should say, to those positions as well. Maybe taking a look at some bear put debit spreads that are 30 to 45 days out, slightly in the money, maybe at the money as well. With a sell warning coming up, I'm not looking at neutral strategies right now, but they would have worked okay in the past 2 to 3 weeks or so. But yeah, that's not what I'm looking for right now. All right, so I'm thinking about changing patterns. We'll have more on that later. Not in this discussion, but we'll have more on that later next week as well.